Hello, and welcome back to another video. In today's video, I'm going to be talking about a question that I hear literally every single time I talk about my long-term portfolio. How do you make money from stocks? I get this question a lot on my TikTok videos. I get this question in my day-to-day conversations whenever stocks come up. I hear this, and I actually used to ask myself this question a long time ago as well. How do you make money from stocks? It's a valid question. So let's jump right into it. You hear me say this all the time. You hear people say it. You read about this in books. You see it in other videos. The number one best way to get wealthy is by owning assets that appreciate in value. Even more so if they are income producing assets. For example, real estate is the best example for this. You buy a house for, let's say, $500,000. If it appreciates in value by, let's say, 5 to 7% in a year, that house that you own, the house that you bought for $500,000, is now worth $535,000. You are now $35,000 richer if it has appreciated by 7%. Now, what if you rented out that property? What if you rented it out for a couple $100 more than the mortgage that you pay every single month? Now, it's an income producing asset. Not only is it appreciating in value every year, but it's also paying you to hold it. You're getting an income on an asset that is appreciating in value. It's great. Now, how does that apply to stocks? Well, stocks, companies, shares, think of it as a mini real estate transaction. Let's take two different examples, one growth stock and one value stock. Let's use my favorites. Let's use Uber for the growth stock and AT&T for the value dividend paying stock. All right, let's look at Uber. So Uber is a house that you live in. AT&T is a house that you rent out. Uber is a house in a great neighborhood. It has great future potential. Let's say you put $1,000 into Uber. Now you own a little bit of an Uber. Now you own a little Uber house that appreciates in value. For this example, let's say Uber goes up 20% in a year. It might actually go up more or less, but as a point of reference, I've been buying Uber every single month since it was about $30 a share. I'm actually currently up 66% on it. At one point, I was up around like 90% or so. But for this example, let's just say 20%. So Uber doesn't pay me a dividend. Uber is purely a growth stock. It's focusing on itself, it's growing in value, it's pouring all of its money that it makes into itself and marketing, and it's growing as much as it can. I own shares in Uber and I'm riding up that appreciation. As Uber becomes more valuable, so does my stock. But back to our example, so you put $1,000 into Uber shares and it goes up 20% in a year. Now your $1,000 is $1,200. You are now $200 wealthier since your investment has appreciated 20%. Now, what happens if you keep holding it? You could go up another 5, 10, 20, 30, 60, 100%. If you truly believe in the value of Uber and you think that they are going to be doing what they are doing now, but better and more efficiently in 10, 20 years, your $1,200 could go up another 20, 30, 40%. Now imagine that 10, 15, 20 years. That adds up. But wait a minute. That's all just unrealized gains. You haven't actually made any money yet. All that happened was your asset appreciated in value. You don't make money until you sell, right? Wrong. You can make money from stocks if you own 100 shares of it. Let me introduce you to a covered call. According to Investopedia, a covered call refers to a financial transaction in which the investor selling call options owns an equivalent amount of the underlying security. To execute this, an investor is holding a long position in an asset, then writes or sells call options on that exact same asset to generate an income stream. The investor's long position in the asset is to cover because it means the seller can deliver the shares if the buyer of the call option chooses to exercise. Pretty much if you own 100 shares of Uber, you can sell calls and collect a premium or collect an income. You collect that income, you collect that premium because you are selling the right for someone else to buy those 100 shares from you at a specific price. Now, let's hop over to Robinhood. It's super easy to visualize on Robinhood. I don't really use Robinhood that much anymore. I buy $100 worth of a random stock that you guys pick on TikTok every single month. Also, if you want to sign up with Robinhood, I have an affiliate link down in the description. You get a free stock, I get a free stock, so it's a win-win. Check it out if you haven't already. Also, while you're down in the description signing up for Robinhood, just hit that subscribe button really quick. Okay, anyways. So let's say you bought Uber when I bought Uber. I've been buying it since it was like $30 a share. My average cost basis is around $32 or so. That means I have at least 100 shares of Uber, and my average cost per share is about $32 a share. Now, how do I make money from Uber? Let's sell a call. I hop over to the options chain, go to a date that's about a month or so out so I have enough time to be right. I scroll up and I find a strike price or share price that I don't think Uber will get to by that expiration date. I check the premium. For example, this one, the $60 calls are going for $35. That means you get paid $35 for the right to sell 100 shares of Uber to somebody for $60 a share. Remember, you got Uber for around $32 a share in this example. You're about to enter a win-win scenario. How? You want to make money, right? As soon as you sell that $60 contract, you will be credited $35. Let's talk about what can happen here. Either your contract expires worthless, which means you walk away with your 100 shares and you walk away with the $35 premium, or the worst case, you sell 100 shares of Uber for $60 a share. But that's okay, isn't it? Because you bought Uber at $32 a share. The thing is, if Uber really did go up a lot, let's say it goes past $60 a share, if it goes to 70, 80, or 90, you just missed out on that growth opportunity. You're risking opportunity cost for that premium that you're getting paid. So you just turned your Uber into an income producing asset. You can rinse and repeat this process every single month and collect that premium and make money from your stocks. Now imagine 5-10 years from now when you have thousands of shares of a company after adding to your positions every single month and dollar cost averaging your way into a sizable position like I say everybody should, you can do these strategies really well with low risk. Now that we've talked about growth, let's talk about a value dividend stock. Let's take AT&T for example. AT&T doesn't really move. I've been adding to it for a while now and it's pretty much the same price right now as when I bought it. My average is $29 a share or so. It just doesn't move. So why would you like an asset that doesn't move? Well, it pays dividends. Every 3 months, AT&T pays me for owning their stock. What does that sound like? That sounds like a rental property that pays you. It's stable, it doesn't appreciate much in value, it's not volatile. But it pays you a fixed rate. The cool thing about dividends is that if you have drip on, the dividend reinvestment, instead of paying you cash, it pays you in shares, fractional shares if you don't have enough for one single share per dividend payment. Then it all just compounds on itself and grows at an exponentially increasing rate. So now we know we can sell covered calls on shares. We know we can collect dividends from value dividend companies. There's another way too though. Just sell. You've spent 5, 10, 15, 20 years collecting assets, growing your account to a sizable chunk of money. Again, I hear this question all the time. How do you make money? Well, I'd ask you, why do you want money? What is money? What do you want to do with the money? Once you're able to answer those questions, look at your current situation. If you need extra money, if you need extra power, extra ability to do something, like buy a house, buy an investment property, buy a car, buy something that you just need that little extra boost for, sell some of your stock. You've put your money to work for so long, your money has appreciated in value. Your $100 is now $300. Take out your initial investment. Let the profits do their thing. Do whatever you want to do. Do whatever you want to do. That right there is the most powerful part of this whole concept. Your long-term portfolio gave you the power to do whatever you want to do. And that's how you make money from the stock market. You save, you invest, you let your money work for you, and then you do whatever you want to do. And while you're at it, don't forget to subscribe. We have a lot more videos coming out, so stay tuned, stay happy, and I will see you on the next video.